good morning or good afternoon, as the case may be. In our 202 students, you are welcome to topic 3, lecture 1.2, which is a continuation of the first lecture. We are still on the cost of capital. In the previous lecture, we were able to look at the sources of finance or remind ourselves of different sources of finance. And importantly, we consider the method of issuing securities, particularly the rights issue, which enables a firm to raise fresh capital. At the same time, avoid dilution of ownership. We will continue now by looking at the cost of specific source of capital. But before then, it is important to look at the various sources of capital in a firm's balance sheet. You look at a firm's balance sheet and you look at the shareholders' equity. You're going to find the preferred stock or preference share. And we have the ordinary share equity that is made up of the ordinary share and the retained earnings. Then under the long-term liability, we are going to find long-term debt. So we are going to estimate or discuss the calculation of each of these items. And eventually, we'll be able to determine the weighted average cost of capital, which is the overall cost of capital for the firm. And this overall cost of capital takes into consideration the various costs of capital as reflected in the firm's balance sheet or capital structure. So the weighted average cost of capital considers the overall impact of financing because firm's capital is a pool of long-term funds from various long-term sources. Now let's start with why a firm needs to know its cost of capital, which I described briefly in the first lecture. And let me emphasize it again, that the whole essence of analyzing the cost of capital or different source of financing is to arrive at the weighted average cost of capital. And eventually the firm will use the weighted average cost of capital to evaluate the cash flow from any investment opportunity of a given project in order to determine its NPV to the company, to determine if taking on the project will create or destroy shareholders' value. It must be noted that when the cost of capital is overestimated or is too high, when it is overestimated, the firm will end up rejecting many profitable projects. And when it is underestimated, the firm will accept many unprofitable projects. And when you understand the fact that which amount of money is committed to this long-term project, we will know that the firm cannot afford to make big error or unnecessary error when it comes to the estimation of cost of capital. We will make some assumption so that we can isolate the discussion of cost of capital. For example, we are going to hold some factors constant. The cost of capital is affected by economic factors and firm-specific factors. However, in order to have a good understanding of this cost of capital, we are going to isolate the cost of capital by holding various factors that affect some of these factors that could affect the cost of capital constant. We are going to hold them constant. For example, we hold the business risk constant, which is the risk of firm being unable to cover its fixed operating costs rather. So we assume that this risk is constant, is unchanged. We also assume that the financial risk is constant, which is the risk that firm will not be able to pay the required financial obligations. So we also hold it constant. And we also assume that the cost of capital is the after-tax cost of capital. So cost of capital is measured on an after-tax basis. The key item that could affect the estimation of cost of capital is flotation cost, which we have explained earlier as the cost associated with issue of security, and it's made up of underwriting costs and administrative costs. So the cost in most cases is huge, and it is important to look at its impact on the cost of capital. So one way to deal with this cost is to obtain the net proceed from the sales of a particular security. So to obtain the net proceed, we are going to deduct the flotation cost from the proceed, from the actual proceed, or from the current market price of a particular security. As we will see in our subsequent examples, the first source of capital that we are considering is the debt. Now we want to look at the cost of long-term debt. So firm may issue debenture or raise long-term loan from financial institutions, as we have discussed. In the case of long-term debt, there are key features such as its tax deductibility that allows firm to pay interest on debt before the payment of tax. And by so doing, firm is able to save certain amount of money. You will remember that when you look at the firm's income statement, you will discover that firm pays dividend on preference share and dividend on ordinary share after tax payment, after the payment of tax. When in the case of interest on debt, it is paid before the payment of tax. So it is assumed that by allowing company, because government allows company to pay interest on debt before the payment of tax, firm is able to save certain amount of money known as tax savings, and that is why one of the key advantage of debt usage is interest tax shield. The tax savings is also known as a tax shield because it's coming from government. That is the money that could have been paid to government if the company is to pay interest on debt after tax payment. So in essence, we are saying that interest on debt is tax deductible, is an allowable expense for tax purpose. Payment to shareholders are not tax deductible. Looking at the cost of debt, there are different ways to determine the cost of debt. The cost of debt itself is the return that lenders require on the firm's debt. It is the return that the lenders require on the firm's debt. And this can be determined in two ways. So the cost of debt can directly be observed through the interest rate that the firm has to pay on its borrowing. For example, if I obtain a loan from commercial bank and I'm expected to pay 10%, or a company obtains loan from commercial bank and the company is expected to pay 10%. So the coupon, the interest rate associated with that loan is 10%, and it can be treated as the cost of debt, especially if we do not have to consider maybe flotation costs and all other things. That is, all other things being equal, if a debt instrument is trading at its par value, so the interest rate on that debt is equal to the cost of debt. And that means we can use cost quotation. Then another cost quotation that can be used is the yield to maturity on debt with similar features. If there are two companies that are rated as BB, there are rating companies such as Moody's and S&P. So if they have rated two companies bond as BB, or the two companies are rated as having similar risk, therefore, the yield to maturity on company A's bond can also be used or considered as the ideal yield to maturity on company B's bond. So this is also a cost quotation. Then another way of determining the cost of debt is by calculating the cost of debt. And by calculating the cost of debt, we mean by determining the internal rate of return that is associated with the debt. In this case, we want to determine the discount rate that equates the current market price of debt to the present value of future cash flow associated with the debt or bond. So that is in the case of existing bond. But if we are talking about maybe new issue of bond, so we can see it, the internal rate of the return as the discount rate that equates the net proceed from the issue of a new bond to the present value of the future cash flows associated with the bond. The future cash flow associated with the bonds are the interest rates payable on the bond, as well as the terminal value at maturity. That is the face value that will be paid to the lender at maturity. And this internal rate of return can be determined using financial calculator. It can be determined using spreadsheet, electronic spreadsheet. Otherwise, we have to determine it using trial and error techniques. And by trial and error techniques, we continue to guess a discounting factor that will equate the proceeds from issue of debt to the future cash flow associated with this debt. So looking at the examples that we have on this slide, we have an example of a bond of a company that has issued a bond with 25 years left to maturity, and the coupon rate is 9%, payable semi-annually. The bond is currently selling for 908 Rand 72 cents per 1,000 rand bond, suggesting that the face value of the bond is 1,000. As a matter of fact, bond is usually denominated in 1,000. So we are to determine the cost of this debt, and we can use the financial calculator to do that. So using the financial calculator, the N is 50 years. Remember that the year to maturity is 25, but the interest rate is payable semi-annually. As a result of that, our N will be multiplied by 2. The present value of the debt is given as 908 rand 72. The payment period is 45 rand. The annual payment will be 90 rand, which is 9% of the face value, which is 90. But because it's payable twice or semi-annually, then we divide it by 2. So the future value remains 1,000, and we can obtain the yield to maturity using financial calculator by plugging these values using our financial calculator. So the answer will be 10%. We can consider another example, which is the cost of debt and the implication or the effect of flotation costs. There are certain costs that companies incur in the process of issuing this security. So looking at this example, we have a company, a major retailer, who's contemplating selling 10 million worth of 20 years 9% coupon, stated annual interest rate. So it is important for you to pay attention to your question. This one is stated annual interest. The previous one we consider is payable semi-annually. So each with a par value of 1,000. Because similar risk bond hence returns greater than 9%, the firm must sell the bond for 980, suggesting that the firm is selling this bond at discount to compensate for the lower coupon interest rate. The flotation costs are 2% of the par value of the bond. Therefore, the flotation cost is 2% of 1,000, which is 20 rand. So in this case, the firm is selling at discount at 980, and we must also deduct the flotation cost from the current market price of that bond. Therefore, the current market price of that bond is 960, which is 980 minus 20 rand flotation cost. And therefore, the net proceed from the issue of this bond is 960, which must be used in determining the cost of this bond. If we use our financial calculator, if the net proceed of a 1,000 9% coupon interest rate 20-year bond were found to be 960, as we have seen in the previous slide, what is this bond yield to maturity? So we can use our financial calculator, and we have the value in this table. If we plug it into our financial calculator, we are going to arrive at 9.452%. So that is the yield to maturity. But you must note that, like I said, when we are making some assumption, that the effective cost of debt is measured on after-tax basis. And therefore, if you are giving the tax rate for this company, you must multiply this 9.52% by 1 minus T to arrive at after-tax cost of debt. As I mentioned earlier, we can also use Excel to determine the cost of debt. And lastly, we can also use this formula that we have here. And with this formula, we have I, which is equal to the annual interest rate in rand. We have ND, which is equal to the net proceed. The N is the number of years to the bond maturity. The 1,000 is the par value If we use this formula, we are also going to arrive at this. There's a difference between this, a marginal difference, like this one is 9.39, while the one we obtain using financial calculator Excel is 9.45 or thereabouts. So it's an approximation issue. In the process of approximating and rounding off, that's where the difference comes up. Now we proceed to the cost of preference share. Remember that I reiterate that the effective cost of debt is measured on after-tax basis. In the case of preference share, cost of preference share can be determined. But to determine it, we need to remind ourselves of the various features of preference share. Preference shares represent a special type of ownership in the firm. It's a form of ownership. It gives its holder right to receive a fixed dividend that is stated on the preference share. It's also stated in form of percentage, just like the debt. So it's also fixed before the firm can distribute earning to the ordinary shareholders. Therefore, they enjoy priority of earnings over the ordinary shareholders. Preference share dividend can be stated as a rand amount, say 4 rand. It can also be stated as a percentage. For example, 8%. Okay, now it can be stated as, say, 4 rand preference share. And it can also be stated as, say, 8% preference share. The 8% is worked out on the preference share par value. So if the par value is 50 rand, then 8% will be 4 rand. So you must determine the preference share dividend before you can calculate the cost of the preference share dividend. So it's a form of ownership that is expected. It's a form of ownership, and the holder of a preference share is expected to hold it indefinitely. What do I mean? To hold it indefinitely means that the only way the holder of this share could realize or could get his money is to sell this preference share to another person. Although there are different types of preference share, but as far as this topic is concerned, we are dealing with a perpetuity, a perpetual preference share. So, which allow us to use our knowledge of perpetuities for the estimation of the cost of preference share. So a preference share is a perpetuity. So we can take the present value of a perpetuity formula, rearrange and solve for preference share, the cost of preference share. So in this case, the cost of preference share is simply the ratio of dividend that firm must pay on the preference share to the net proceed that the firm receive from the preference share. So for existing preference share, the cost of existing preference share is dividend over the current market price. But the cost of a new issue of preference share is dividend over the net proceed from the preference share. That is when the current price is adjusted for flotation costs and other associated costs or the effect of underpricing. An example is given on this slide. Your company has a preference share that pays annual dividend of 3 rand. That is, these are 3 rand preference share. If the current price is 25 rand, what is the cost of the preference share? So the cost of the preference share is 3 rand divided by 25 rand. 3 rand divided by 25 rand, which will be 12%. Then if the par value is 50 Rand, what is the annual percentage rate on this preference share? We need to obtain, we know that the dividend on preference share is 3 Rand. So the question they are asking is, what is the annual percentage rate on the preference share if the par value is 50 Rand? So the question you must ask yourself is, what percentage of 50 Rand will give a dividend of 3 Rand? So if you calculate that, you are going to arrive at 6%. So this is also a 6% preference share. Now, we proceed to the cost of ordinary share. It is important to state that there are two main methods that can be used to determine the cost of ordinary share equity. We have the constant growth dividend model, known as Gordon model, and we have the security market line or capital asset pricing model. So I think you are familiar with these models, and I'm not going to waste much time on capping because you did it even in the previous topic. But I'm going to dwell a little on the constant growth dividend model. We must also remember, as we see it subsequently, that ordinary share equity consists of ordinary shares raised externally and the one that is raised internally through the retained earnings. So from the dividend growth model of Gordon, we can solve for the cost of equity. So if we solve for the cost of equity is giving us the expected dividend divided by the current market price plus the growth rate. And it must be noted that where flotation cost is incurred, but this formula will be much relevant for existing preference share. But in the case of new issue of preference share, there must be an adjustment for flotation cost. Therefore, the flotation cost will be current market price minus, the net proceed will be equals to the current market price minus the flotation cost, and we arrive at the net proceed of that particular equity. It must be remembered that D1, that is the expected dividend, is equals to D0, previous dividend, adjusted for the growth rate. We have an example to drive home our point. Suppose that your company is expected to pay a dividend of 1.5 Rand per share next year. There has been a steady growth in dividend of 5.1% per year, and the market expects this to continue. The current price of this particular company's ordinary share is 25 Rand. What is the cost of the equity? So the cost of equity is given by dividing the expected dividend by the current market price plus the growth rate. So, and that gives us the 11%. Note that in the case of preference share and ordinary share, you don't need to adjust for tax rates or tax payment, because dividend on preference share and ordinary share are paid after the payment of tax, unlike the interest on debt that is paid before tax payment. Now we see that an important component of the cost of preference share equity formula is the growth rate. And we need to expose ourselves to different ways by which this growth rate can be determined. We can use the historical growth rate. For example, when we have the dividend history. We can determine the growth rate from dividend history. And the second method is to use analyst forecast. Analyst forecast of growth rate. In the stock market, there are analysts who are involved, who are busy trying to determine, to pick the undervalued and overvalued stock. But in addition to that, they also spend a lot of time to forecast earnings per share and expected growth rates of different companies. So we can use their forecast of the growth rate as G in determining the cost of equity. For more information on that, I have a link on these slides that you are expected to visit to have an idea of what the analyst forecast does. Then the third means of determining the growth rate is to multiply return on equity by retention ratio. And the reason for this is because the only way a firm can grow without issuing new security or new equity is to make use of retained earnings. So the maximum rate that the firm can grow without using additional financial leverage is calculated by multiplying the return on equity and the retention ratio. So the return on equity, we know how to calculate that. The retention ratio and the payout ratio must be equal to 1. So we can also determine the retention ratio if we have an idea of the payout ratio or the dividend per share or the earnings per share, as the case may be. So we have on these slides some formulas that will help to go about the determination of the relevant component of the third way of determining the growth rate. We're talking about the return on equity, which is net profit after tax divided by total equity. And to calculate the retention ratio, we said that the retention ratio is plus the payout ratio is equals to 1. Then if you know the payout ratio, just deduct that payout ratio from 1. So the balance, the difference would be retention ratio. Retention ratio or the reinvestment rate is also equals to the retained earnings divided by current earnings. So the formulas on these slides can help you depending on what you are given in the problem or in the question. Well, an illustration here on how to estimate the dividend growth rate. Suppose a given share has a return on equity of 20% and a retention ratio of 4% at 0.4. What is the firm's growth rate? You can determine the growth rate by multiplying the two. We are going to get 8%. Now, we have additional question. What is the firm's, if the earnings per share is equals to 5 rand, what is the dividend per share? If the earnings per share is 5 rand, what is the dividend per share? Remember that retention ratio is equals to retained earnings over earnings. So like I said the other time that you can determine the dividend per share in this case. Since we already have our B as 0.4, we know the value of our earnings per share, and what we are looking for is dividend per share. So earnings per share minus dividend per share divided by dividend per share will give us retention ratio. So that is the formula for retention ratio. Now we have at least the earnings per share. So the only thing we don't have is dividend per share, and we have the retention ratio. So we can solve for the dividend per share, which will be equals to 3. And another way that the first method we mentioned when it comes to the determination of dividend growth rate is that we can use dividend history to determine the dividend growth rate. So we see the formula that we have on this slide. We obtain the percentage change over time, the past 5 years, and we get the average of the 4% changes, and that will be equal to 5.1%. And another formula we can use is this one. So with this formula, we divide the last or the current dividend by the first dividend. This is the current dividend, 2008, and the first one is in 2004. So we divide it, and this is raised to power 1 over n. And this n is number of years, which is 5 years from 2004 to 2008, minus 1. We are still going to arrive at 5.1%. So that is the average, which is the growth rate in this case, historical average in this case. And it is important to look at the advantages and disadvantages of dividend growth model vis-a-vis the capital asset pricing model. So they are available on the slide, and you are expected to look at them. For example, the dividend growth model of estimating the ordinary share equity cost of capital is easy to understand and use in terms of computation. It is also easy to adjust for flotation costs than the capital asset pricing model. In terms of the disadvantage, it is only relevant for companies that pay dividend. It is not applicable if the dividend is not growing at a constant rate. The cost of equity estimated by this method is sensitive to the estimated growth rate. So the cost, if the growth rate increased by 1%, the cost of equity increased by 1%, and it does not explicitly consider risk. Now, it must be mentioned that another way of determining the equity or the cost of ordinary share equity is to use the security market line. I'm not going to go through this because I assume that you are familiar with it. So, why the cost of ordinary share equity using the DDM, that is the Gordon dividend discount model, indicate that the value of ordinary share is equal to the present value of future dividend that is expected to that ordinary share is expected to provide indefinitely. Capital asset pricing model describes the relationship between the required return and the non-diversifiable risk of the firm that is measured by beta. So you are familiar with it. If you have relevant information, you can estimate capping. Let's look at the example we have on this slide. Suppose your company has an equity beta of 0.5, current risk-free rate is 6.1%. The expected market risk premium is 8.3. What is the cost of equity? You see the cost of equity is 10.9%. And the SML also has its own advantages and disadvantages. For example, it explicitly adjusts for systematic risk. It's applicable to all companies as long as we can compete better. And it has a stronger theoretical foundation than the dividend discount model approach. In terms of disadvantages, one has to estimate the expected market risk premium, which does vary over time. Beta also varies over time. In other words, one will be relying on the past to predict the future, which is not always reliable. Now, example on the cost of equity. We have an example on this slide, which is similar to what we have done. So another example is that the market risk premium is given and the risk-free rate is given. The analyst estimate of the growth rate is also given to be 6% per year, and the previous dividend paid was 2 rand. The current market price of the ordinary share is 16 rand 25 cents. What is the cost of equity? In this case, we know the D naught to be 2 rand. We know the growth rate to be 6%. That means we need to get the expected dividend by adjusting this D naught 2 rand for the growth rate of 6%. What again do we need? Our share are currently selling for, we know the current price of this share. So we can divide whatever we get when we have adjusted the previous dividend. We can divide it by this 16.25 and we will get the cost of equity using the DDM. But the information available to us also enables us to use the capping, the capital asset pricing model. We have the risk-free rate, we have the market risk premium, and we have the beta. So using the second formula, we are going to get 19%. The first formula, we are going to get 18%. So we have to use the information that is given to us. Now, another way of determining the cost of ordinary share is to determine the cost of equity. Ordinary share equity is to determine the cost of retained earnings. Instead of issuing new ordinary share, the firm may embark on using retained earnings. So in this case, part of the earnings that should be distributed in the form of dividend will be retained for reinvestment in the company. And as a result of that, it is assumed that the existing ordinary shareholders are providing additional capital, and this must be at a cost because company must be able to use it in such a way that the value, the shareholders' value will be maximized. So the basic difference between the cost of retained earnings and the cost of new issue of ordinary share is that there will be no need to adjust for fluctuation costs because no fluctuation costs will be involved, will be incurred. So cost of retained earning in essence is the same as the cost of equivalent fully subscribed issue of ordinary share. The only thing is that we don't adjust for fluctuation costs. So the cost of retained earnings, as we show on this slide, is equal to the cost of existing ordinary share. Now, then the cost of new issue of common stock must be able to strike the differences between the three. There's the cost of existing ordinary share, and the cost of existing ordinary share is the discount rate that equates the current market price to the present value of the dividend. The present value of the future dividend adjusted for which is adjusted for the growth rate, expected to grow at a constant rate. Now, in the case of new issue of common stock, the cost of new issue of common stock is the discount rate that equates the net proceed. When we mention net proceed, you must know that adjustment has been made for flotation costs, under pricing, and what have you. So now the cost of new issue of common stock, where it is new issue of common stock, we must adjust the P note, the current market price, for the associated flotation cost. So the new shares are underpriced if the stock is sold at a price below its current market price, as we are aware. So for a new issue of common stock, the formula on this slide is relevant, it's useful. The only difference between this and the cost of existing ordinary share is that instead of P naught or current market price, we have net proceed. So we can use the cost and growth valuation model to also determine the cost of new issue of ordinary share. We have an example on this slide of a corporation whose common stock is currently selling at 50 Rand per share, and the expected dividend is 4 Rand. And to determine the cost of new common stock, the company has estimated that the new share can be sold for 47 Rand. So there is 3 Rand per share underpricing, which is due to the competitive nature of the market. So there is underpricing of 3 Rand. Perhaps there are other companies that are issuing security to the market at the same period, and the company just wants to ensure that it's able to raise the required fund. So there will be a need to attract the subscriber. So a second cost associated with a new issue is flotation cost of 2 Rand 50 cents per share that will be paid to issue and sell the new share. So the total underpricing and flotation cost in this case will be 2.5 plus 3 Rand, and that will give us 5.5 Rand 50 cents. And we need to deduct this 5 Rand 50 cents from the market price. We need to deduct it from the market price. So we deduct 5.5 from the current market price of 47 Rand. Then the net proceed will be 44.5. And we know that the expected dividend is 4 Rand. So we can determine the cost of new issue of this security. We also have the growth rate, which is okay. It's not given on this slide, but you will be given the growth rate, which is 5%. It's missing the question. So the growth rate is 5%. It must be given in the question. So in essence, the cost of new issue of this security is 14%, or the cost of new issue of ordinary share equity in this case, in this example, is 14%. Now that we are familiar with the method of determining the cost of individual source of capital, we have looked at the cost of preference share, cost of bond, and cost of ordinary share. The essence is to be able to determine the weighted average cost of capital. Like I said, we can use the individual cost of capital that we have computed to get the average cost of capital. The average is the required return on the firm's assets based on the market perception of the risk of the assets. So the weights are determined, because we just mentioned weighted average, by how much of each type of financing we use. So we must determine the weight for debt, for preference share, and the weight for ordinary share if the firm's capital structure contains these three. So we can see that there are two items we need to understand in the case of weighted average cost of capital. I said that the weighted average cost of capital is the overall cost of capital, and it's the weighted average of the cost of individual sources of finance. So first, we need to understand the weighting part of the WACC calculation, and then we need to look at the effect of taxes on our cost of debt. So looking at the weighting method, we must note that the total value of a company is equal to the market value of the firm's debt and equity. And if there is preference share in the firm's capital structure, it will be equal to the market value of debt, equity plus preference share. So the weight of each of them will be equal to the market value for the equity, for example, the market value of equity divided by the total market value of the firm, which is the V. Then the weight of debt will be market value of debt divided by the market value of the firm. Then the weight of preference share will be equal to market value of preference share divided by market value of the firm. So it's a key component of the weighted average cost of capital calculation, the weight. And the formula for the weighted average cost of capital is given on this slide. If the firm's capital structure is made up of equity and debt only, then this formula will be appropriate, where we have weight multiplied by cost of equity plus weight of equity multiplied by cost of equity plus weight of debt multiplied by after-tax cost of debt. Where the capital structure is made up of equity, debt, and preference share, then there will be additional component, which is weight of preference share multiplied by, which is to add the weight of preference share multiplied by the cost of preference share. As we have it on this slide, we have an example. We are given the cost of debt to be 5.6, cost of preferred stock to be 10.6%, cost of retained earnings to be 13%, cost of new common stock is equal to 14%. You will notice that the cost of retained earnings is usually less than the cost of common stock for a reason we have mentioned. For example, cost of retained earnings does, in estimating the cost of retained earnings, we don't need to account for flotation costs. So by accounting for flotation costs in the case of cost of new issue of common stock, the cost of new issue of common stock increases. So flotation costs increases the cost of new issue of common stock. And as a matter of fact, flotation cost increases the cost of capital where it is incurred. That is, we are given the cost of about 4 components of the firm's capital structure. Now let's look at the company uses the following weight in calculating its weighted average cost of capital. So it is assumed that the weight of long-term debt is 40%, the weight of stock is 10%, and weight of common stock equity is 50%. This 50% can also be used as the weight of, it can be used interchangeably with the weight of retained earnings. So to determine the weighted average cost of capital from the information provided on the previous slide, we must multiply the weights of each financing source by its corresponding cost. Weight multiplied by the corresponding source. So in that case, corresponding cost. So in that case, the weighted cost for long-term debt is 0.4 multiplied by 5.6%, which is give us 2.2%. In the extended slide that you have online, there are procedures that must be followed, or there are guides that will assist you in estimating the weighted average cost of capital. There it is indicated that it is better to write the weight in decimal while you write the cost in percentage. So you must pay attention to that. So multiplying the weight by the cost, we are going to get the weighted average cost of capital when we sum up the weighted cost, and the weighted average cost of capital in this case is 9.8%. We're still on how to determine the weight. Suppose you have a market value of equity equal to 500 million and the preference share with a market value of 75 million rand, and the market value of debt is 400 million rand. So to determine the V, which is the total market value, you must add up the three: the market value of preference share, equity, as well as debt, and that will give us 975 million rand. So the weight of equity is equals to the value of equity divided by the market value of the firm, and that will be 51.28%. The weight of debt is equals to the market value of debt divided by market value of the firm, and the weight of preference share is equals to market value of preference share divided by the market value of the firm. Now, we continue in terms of weighting scheme, weighting method. So sometimes you are not given the total value of the relevant sources of capital, but you are given the debt equity ratio, and from the debt equity ratio, you can determine the debt ratio and the equity ratio. The weight of debt and the weight of equity. You must pay attention to, you have extended information on the slide that you are expected to read up. When you are giving information, you must pay attention as to whether you are giving the book value weight or the market value weight. If you are giving the book value weight and market value weight, you are expected to use the market value weight, because the book value weight will reflect the book value of these different sources of finance and accounting value of these different sources of finance as it is in the balance sheet. But the market value weight or the market value will reflect the current market value based on the prevailing price of this share in the market. In addition, if you are given the target structure weight, and you are given the target capital structure weight, that's what you are expected to use. So in converting if you are given another weight that is not a current weight, you are expected to ignore that, because it is the target capital structure weight that will show you the desired capital structure that a firm plans to have. And this desired capital structure reflects what the company wish to have, and it is futuristic and it should be used. So back to the capital structure weight. If you are given the debt equity ratio to be equals to 25%, it implies that debt is equals to 25 and equity is equals to 100. That is where you can get 25. If you are given the debt equity ratio of 50%, it implies that debt is equals to 50 and equity is equals to 100. And with this value, in our current case, we have 25% or 0.25, which suggests that debt is 25 and equity is 100. With this value, we can determine the debt ratio, that is the debt to value ratio, and we can determine the equity ratio, meaning equity to value ratio. Now that, since we know that debt plus equity will give us value, we must remember that value is equal to debt plus equity. So in this case, and we know debt, we know equity. So with this value, we can determine the debt ratio, which is debt over value, which will be 20%. And we must know that if debt to value is 20% and we only have debt and equity in the capital structure, then equity ratio or equity to value will be 80%. So you must pay attention to this area. Now we have an example on work. We have information on this slide. Equity information shows that this firm has a 50 million share that is trading at 80 Rand per share. The beta is 1.15. The market risk premium is 8%. Risk-free rate is 5%. With this information, we can calculate the cost of equity using capital asset pricing model. Now, in the case of debt information shows that the face value of this firm's debt, the debt outstanding is 1 billion Rand face value. So the current price is 110%. Usually, like I said earlier, bond is usually denominated in 1,000, like 1,000. So if the current market price is 110%, it shows that the current market price is 1,100 Rand, and the face value is 1,000. So the coupon rate is 9%, payable semi-annually, and the maturity period is 15 years. Tax rate is 40%. So to determine the cost of equity, we can use the capital asset pricing model. And in that case, the cost of equity is 14.20%. All this information have been given to us in the question. So in the case of debt, we can make use of financial calculator to determine the yield to maturity. So with the actual maturity period is 15 years, but because the interest is payable, the coupon is payable semi-annually, so we must multiply that by 2. So 15 years multiplied by 2 will give us 30 years, or 30 times that this coupon will be paid. And the coupon ordinarily should have been 90 Rand, but because that is 9% of the face value, which is 1,000, which will be 90, but because it's payable semi-annually, we also divide it by 2. And if we plug the value into the financial calculator, we obtain the yield to maturity of 3.9268 multiplied by 2. Now we are going to arrive at 7.854%. Remember that the question indicates the tax rate for this particular company, and as a result of that, and you have been told that the effective cost of debt is the after-tax cost of debt. So this must be multiplied by 1 minus T. So therefore, the cost of debt will be 4.712. You will discover that tax shield reduces the cost of debt, which is advantageous to the company. And furthermore, we are to determine the capital structure weight based on that particular question. And we are given a question that shows that the firm has a 50 million ordinary share that is trading at 80 Rand, suggesting that the value of equity is 4 billion. Then for debt, there is a 1 billion bond that is trading at 1.1, that is 110%. So suggesting the value of this particular bond is 1.1 billion. So that suggests that the value of the firm is 4 billion plus 1.1 billion, which will give us 5.1 billion. Now we know the value of equity, we know the value of debt, and we can therefore obtain the weight of debt and the weight of equity. So the weight of debt will be 4 billion divided by 5.1 billion, and the weight of equity will be, the weight of equity will be 4 billion divided by 5.1 billion, and the weight of debt will be equal to 1.1 billion divided by 5.1 billion. So now that we know the weight and we have calculated the cost of equity in the previous slide, we have also calculated the cost of debt in the previous slides. So we can determine the weighted average cost because we now have the needed component to determine that. So if we plug in the component into the formula, we are going to arrive at 12.15%. In your extended slides, there are so many other examples. There are some that I decided not to complete because based on what we have done, you should be able to apply the knowledge of what we have done to answer those questions. So I expect you to answer those questions. And if there is anything that is not clear about those questions, you can contact the ADO, and you can also contact me via email. Thank you. So we are going to finish this topic in the next video by looking at the weighted marginal cost of capital, as well as the investment opportunity schedule, and how these two can be used to make investment decisions.